Okta is the global leader of an $80 billion market. After the company posted mixed results for the second quarter, its stock crumbled 30%. In this video, I'm going to do an in-depth DCF analysis to see what's the real intrinsic value of the company, if it's a good moment to buy or if it's a value trap. Before we start, please remember this is not financial advice and you should always do your own due diligence. Alright, so this is the model. Here I have the full list of assumptions. And as you can see, I have here the revenue and the EBIT margin, the operating income margin. I took the last 3 years and then I have forecasted for 2 periods. First of all, I have forecasted a growth phase where the company grows between 40% and 70%, and after that I have a slower growth ranging from 15% to 7%. Please be aware that revenue is the most important input for your DCF analysis, so it is very important for the revenue to be forecasted as well as possible. I have assumed that the company will attain its revenue prediction for $4 billion in financial year 2026, and what I've done is I've baked into the operating margins the expectations for the 3 scenarios, and then I applied a slower growth for following years, which will obviously apply for a mature company. The next step after I estimate the revenue is the EBIT margin. This is important because we're trying to get to the unlevered free cash flow, which is our main objective, to find out the present value of future cash flows. One thing that I need to clarify here, these are GAAP operating margins. I have estimated that the EBIT margin will be 25% in the financial year 2027. I estimated that this would be a necessary margin in order to attain the free cash flow that the company expects to have in 2026. I used a formula between minus 30%, what I assumed this year, based on our current expectations, because we're already at the middle of the year. I took the difference between those two and I added half of it every year. This is a formula that I've seen the model run using, and so I imagine that it is a good way to actually estimate my margins. I estimated an operating margin for a terminal year, and how I did that is by looking at the margins. And so this is a database from the model run, and it has here an EBITDA margin of around 30%. For the bull case, I predicted a 35%, and for the bear case, I predicted a worst case scenario, only 10%. I applied the same formula. I added the half of the difference, 5 difference between 30 and 35, and so I added here 2.5, and that's progressively gonna bring towards 35%. Next up, here I use the net operating loss balance, and next we have the net operating profit after taxes. So I assume the company won't be paying taxes until financial year 2026. Now, going further on the depreciation amortization, I took the historical average. We see here 3.2%, and I've estimated a 4% every year in the first phase, and then a 3% for capital expenditures. We see here an average of only 1.7, but what I've done here is I've used 4% just to be on the safe side. Since this company is mainly software, and as we've seen in the last couple of years, it doesn't have big amounts of capital investments, I believe that the difference in intrinsic value will not come from these 3 elements that I have highlighted here. Next up, the discount rate is very important for a company. I took the risk-free rate. For the equity risk premium, I came back to the same file that I have used before, the historical estimations from the model run. Here I have used the biggest equity risk premium that I've seen this year. It was at the beginning of July, it was around 6%, and as you can see here, I also used a pre-tax cost of debt of 455, which is last 12 months interest expense divided by total debt. And what I've done here, I took 3 competitors for Okta, and I have calculated the levered beta for Okta, and the levered beta is around 1. I have come up to a weighted average cost of capital. Now, what I have done to be on the safe side, I started with a much higher discount rate in order to encompass some of the risk that is associated with the company. I started with a 12%. I think that it is pretty well on the safe side, 12%, and I have lowered it progressively until the target of 6.87, and we have the present value of unlevered free cash flow. So I have calculated this until the terminal year, which is the financial year 2033. One important thing that I forgot to mention about revenue is here that I have seen the compound annual growth rate between 2021 and 2031. I have compared it with the industry's average, and the industry's average is expected to be around 14%. So I have estimated that Okta, being a market leader, will be able to sustain a growth that will be a little bit bigger than the industry average. So the industry average is around 14.5%. Before going into the terminal values and finding out the true intrinsic value of Okta. If you enjoyed this analysis, please hit the like button and consider subscribing. One of the most important things now after estimating the present value of future cash flow is the terminal value. And for the terminal value, we have several methods of estimating it. I have used 3 methods. First of all, the most important one is the perpetual growth. This is the only method that shows a true intrinsic value estimation because it does not take into account any other market valuation. It does not take any peer valuation into account, and so it's strictly based on the free cash flows of the company. But I'm gonna start first with the revenue exit method, and what I've done is I took the price to sales again from the model run for the last 6 years until 2020. So I have ignored the impact of the huge massive quantitative easing, and so what I've done is I have attributed actually these to the 3 scenarios. And in the base case we have a 5.9 2026 revenue, which is obviously the $4 billion. There's one thing I like about Okta: they have always kept their promises in terms of revenue. However, during the last call, management said that it is actually re-estimating its revenue target for financial year 2026. So I'm not very sure of this 4 billion in financial year 2026. It might be 3.9 billion, but I believe that it will be in that ballpark because I trust the management and their execution. After we take into account the cash and the total debt, we see that the stock is worth around $92, which means a 42% discount. Next up, the multiples method. This is another method that's based on multiples, and it's based on EBITDA multiples. I have taken this approach for the terminal value 2033 EBITDA multiplied with, again, I've taken an average for the companies in this weighted average cost of capital tab. Alright, and by this method have a fair price of $77, which is only a 20% discount. Next up, one of the best methods that you can possibly use is the perpetual growth method. What this method does is it assumes that these free cash flows from the terminal year will grow in perpetuity, and the thing that will give value to the company is this estimated long-term growth rate for the free cash flows. So the growth rate should not be higher than the risk-free rate or the long-term US GDP growth rate. To be on the safe side, I have assumed a 2.5%, 2% and 1.5% terminal value growth rate in perpetuity, and the way in which we get the terminal value is by dividing the terminal cash flows by the terminal discount rate minus the growth rate, and then we get the equity value by incorporating cash and debt. However, we can also check how much does terminal value mean from the enterprise value. As we see here, 81%, between 50 and 80% is a good acceptable value. So in this scenario, the company is worth around $99, which is a 54% discount from the market price. As you can see here, I have made an average, and the average is around 37% discount from the market price. However, if we go on the bearish side, obviously on the bearish scenario, I have tried to incorporate as many bad things as possible. As you can see here, the company won't attain any GAAP profitability until the financial year 2027. Now this bullish scenario is a scenario where everything goes to plan, where the company grows fast but at the same time is able to optimize its spending in order to improve its margins. And so for this bullish scenario, I think we can see here a 91% discount from the market value with an implied price of 123. However, I will stick to my base case, and I believe that this is a fair representation of the market value of Okta. For now, we have an $88 target price. I have also made a sensitivity analysis right here, and so to sum up, I believe that the true value of Okta is somewhere in between these values. No one will ever be able to pinpoint exactly what the value of a company is in the future, but what we can do is we can use our inputs in order to have the best estimation that we can possibly have in order to minimize the chances for error. Alright, that was my DCF analysis for Okta. If you feel like there's something I have left out, or perhaps if you have some improvements that you would do to this analysis, please let me know in the comments below, and I'll try to implement it in the next analysis. If you feel like you've learned anything of value today, or you want to see some more in-depth reviews, please hit the like button and consider subscribing. Until next time, keep crushing it.